Welcome to Aviation Intelligence Weekly with Sarah and Mike, your guide to the aviation industry. The aviation sector just survived one of its biggest shakeups in years. Spirit Airlines collapsed completely this week, wiping out 17,000 jobs and eliminating a major pricing competitor from the domestic market. Meanwhile, the Middle East turned into an aviation no-fly zone, forcing carriers to burn extra fuel on massive reroutes, while jet prices spiked past $180 a barrel.
And somehow, most airline stocks still finished green. Frontier up 29%, American up 13%, United up 10.5%. Either the market's completely disconnected from reality, or
it's pricing in exactly what you'd expect when a low-cost competitor disappears and capacity gets constrained. We'll dig into that pricing dynamic, look at who's benefiting from Spirit's exit, and break down why cargo and aerospace suppliers are suddenly the momentum plays.
Plus, we've got a merger vote that actually passed, insider buying across the industrial suppliers, and some wild divergences between defense contractors and commercial aerospace. This is Aviation Intelligence Weekly. I'm Mike.
And I'm Sarah. Let's start with this week's narrative, because it's not just about one airline failing.
Right. This week's narrative was capacity consolidation accelerating faster than anyone expected, driven by fuel cost inflation hitting the most vulnerable operators first.
Operationally, this means legacy carriers suddenly have pricing power they haven't enjoyed in years, especially on leisure routes where Spirit was the primary low-cost option. When you remove a carrier that was flying 400 daily flights, that capacity doesn't get replaced overnight.
For investors, this shifts the entire competitive landscape. We've spent the last decade watching airlines compete on price in a race to the bottom. Now we're seeing what happens when the bottom player literally can't survive the race anymore.
And it's not just Spirit. The fuel spike to $181 per barrel is creating a natural selection pressure. Carriers with stronger balance sheets and better hedging can weather this. The ones operating on 3 to 4% net margins
and get picked off. Yeah, and that's exactly what the market's pricing in with these airline rallies.
The most important signal this week came from the capacity restructuring that's happening in real time across the domestic network.
Operationally, this means load factors should improve immediately for the surviving carriers, and they can push through fare increases without losing market share to ultra-low-cost competitors.
For investors, this represents the first genuine margin expansion opportunity the airline sector has seen since before COVID, driven by supply reduction rather than demand growth.
Okay, let's look at how this played out in the stock performance this week. TSA screened 12.3 million passengers, up 3.6% year over year and 1.9% above the 3-year average.
So demand is holding up fine. It's really a supply story.
Exactly. And you can see that in the price action. Frontier led the charge, up 29% to $529. American up 13% to $1335. United gained 10.5% to $99.58.
Those aren't random moves. Frontier's the most obvious beneficiary. They're the surviving ultra-low-cost carrier with the cleanest balance sheet. American's got the largest domestic network, so they capture the most pricing upside when a competitor exits.
Even the legacy carriers did well. Delta up 7%, Southwest up almost 8%. Alaska Air, which just completed that debt financing we saw in the 8K, up 10.5%.
The cargo names were interesting too. FedEx up almost 6%, UPS up 4.5%. That's partly the Middle East disruption driving up shipping rates, but also
higher fuel costs getting passed through to customers immediately in the cargo business. They've got more pricing flexibility than passenger airlines.
Right, and then you've got the aerospace suppliers really running. Helmet up almost 13%, HEICO up 8.5%, VSE Corporation, which just closed that precision aviation acquisition, up 14.8%.
What matters is that this isn't just airline sentiment lifting all boats. The suppliers are moving because order backlogs are getting extended, not shortened, as airlines delay deliveries to preserve cash in this fuel environment.
Exactly. Airlines can't cancel orders without penalties, so they're pushing delivery dates out, which actually helps the suppliers manage their own production ramp challenges.
The one sector that didn't participate was defense. Lockheed down 2%, L3 Harris down 3, Northrop down 3, Kratos down 6.5.
That's the classic rotation out of the safer defensive plays into the more cyclical recovery stories. When airlines start showing real margin expansion potential, you don't need to hide in defense contractors.
Although Kratos down 6.5 is more than just rotation, they've been execution issues there.
Fair point, but the more important signal is that commercial aerospace and airlines are suddenly the momentum trade, while defense is getting left behind. The first supporting signal here is that fuel cost inflation is creating a two-tier airline industry: survivors with pricing power versus casualties with unsustainable cost structures.
And we're getting real-time evidence of that in the filings this week.
Let's start with Alaska Air's debt financing. They filed an 8K on May 6th announcing a $500 million senior note offering through Alaska Airlines, the subsidiary, with full guarantees from the parent company.
Timing matters here. They're accessing capital markets while they still can, before this fuel crisis spreads to more carriers.
Exactly. The filing says net proceeds go to general corporate purposes, which is management speak for "we want cash on the balance sheet in case things get worse." And the stock was up 10% that day, so investors clearly approved of the defensive positioning.
Compare that to what happened with Spirit. No filing, no last-minute financing, just a complete operational shutdown when fuel costs hit $4.51 per gallon against their restructuring plan assumption of $2.24.
Right. And that spread, Spirit planning for $2.24, reality delivering $4.51, that's a 95% cost variance on their largest expense item. No airline survives that without massive hedging protection.
Which Alaska probably has, and Spirit definitely didn't.
The Alaska financing also tells you something about bank appetite. $500 million in senior notes, Rule 144A to qualified institutional buyers. That's not distressed financing. That's opportunistic capital raising while the window's open.
And Alaska's network is perfectly positioned for this environment. They don't compete head to head with Spirit on leisure routes. They're more focused on West Coast business travel and connecting Alaska to the lower 48.
So they get the industry pricing benefit without having relied on the ultra low cost model that just imploded.
The other filing that caught my attention was Allegiant's merger vote. Overwhelming approval, 99.8% in favor of issuing stock as merger consideration for Sun Country.
That vote was May 8th, literally 6 days after Spirit collapsed. Talk about timing.
Right. Allegiant Sun Country creates a much stronger combined entity with better route diversification and cost synergies. In a world where fuel cost spikes can kill airlines overnight, scale and efficiency matter more than ever.
The filing shows 44 million votes in favor versus only 32,000 against. That's not a close vote. That's shareholders recognizing this is a survival consolidation, not a growth acquisition.
And both stocks reacted well. Allegiant up 15% for the week, Sun Country up 11%.
The tone across this week's filings was hardened, airlines either raising capital defensively or accelerating consolidation for scale benefits.
The common thread was preparation for a more challenging operating environment, not expansion plans.
Which brings us to the insider activity. We saw buying clustered across the aerospace suppliers and select airlines, reinforcing management confidence in the new competitive dynamics.
Hexel's director purchase is the clearest example. Buying at $92, which is right at current market levels, not a discount.
That suggests the composite materials supplier sees order flow holding up despite airline financial stress. Airlines still need to maintain their fleets, even if they're deferring new deliveries. The second supporting signal is that the Middle East crisis is accelerating a shift toward domestic and shorter haul routes, which favors different parts of the aviation ecosystem.
We're talking about major airspace closures affecting the world's busiest long-haul corridors. The UAE went into aviation emergency mode after that missile strike, with diversions to Oman and Saudi Arabia.
Operationally, this means 5 to 10% longer flight paths for anything routing through that region, which directly hits fuel costs and aircraft utilization. But it also creates opportunities for carriers focused on domestic networks.
That's exactly what we're seeing in the stock performance. Domestic focused airlines like Southwest and American outperforming international carriers.
Southwest up 7.7% makes sense in this context. They don't have Middle East exposure, they're not dealing with international rerouting costs, and they benefit from Spirit's exit on domestic leisure routes.
Meanwhile, the airlines with heavy international networks are getting squeezed from both sides. Higher fuel costs from rerouting, plus the base fuel price spike.
The cargo companies are actually benefiting though. FedEx up 5.8%, UPS up 4.6%. When air routes get disrupted, shipping rates go up immediately, and cargo carriers can pass through fuel surcharges faster than passenger airlines can raise ticket prices.
And there's something interesting happening with the engine manufacturers. GE up almost 6%, RTX up less than 2%.
GE's got the commercial aftermarket exposure without as much defense revenue mix. When airlines are flying longer routes due to Middle East diversions, engine maintenance intervals compress, which drives aftermarket parts and service revenue.
RTX has more defense exposure, which hasn't been working this week, but their Pratt & Whitney engines are also the ones causing delivery delays for Airbus A320neo family aircraft.
Right, and that Pratt engine shortage is one reason Boeing beat Airbus on Q1 deliveries, 143 versus 114. Boeing delivered 114 737 MAXs alone.
Which brings up an interesting point. Boeing's benefiting from Airbus's engine supply constraints, but also from this shift toward shorter haul domestic routes, where the 737 MAX competes directly.
The geopolitical disruption is essentially favoring the domestic-focused U.S. manufacturers and airlines over the international network carriers and European suppliers.
Although Boeing's still dealing with their own regulatory constraints. 40 deliveries per month sounds good until you remember they were supposed to be at 60 by now.
Fair, but the trajectory matters more than the absolute number here when Airbus is constrained by engine availability.
The trajectory only matters if the FAA gives them the ramp-up approval. And I'm not betting on that timeline, given the ongoing safety oversight.
That's a fair pushback, but from a competitive positioning standpoint, Boeing's gaining market share by default while Airbus deals with the Pratt & Whitney bottleneck.
I'll give you that. And with Spirit out of the picture, there's probably less pressure on Boeing to flood the market with MAX deliveries anyway. The surviving airlines have more pricing power, so they don't need as many aircraft to maintain profitability.
Exactly. Capacity discipline is becoming valuable again, which is something we haven't seen in this industry for years.
The divergence this week isn't just about individual stock moves, it's about fundamentally different reactions to the same macro forces. Defense contractors dropping while commercial aerospace surged tells us the market's making a clear cyclical versus structural call.
Let's break that down. On the cyclical side, you've got airlines and aerospace suppliers betting that fuel cost shocks and capacity consolidation create better pricing dynamics going forward. That's a recovery trade.
Right. Howmet up 13%, Heiko up 8.5%, VSE up 15%. These are companies that benefit when airlines have to pay higher prices for maintenance, parts, and services because they can't defer spending on safety-critical components.
Meanwhile, defense is trading like a structural headwind story. Lockheed down 2%, L3Harris down 3%, Northrop down 3%. That's not just profit-taking. That's positioning for a different budget environment.
But here's where I think the market's getting ahead of itself on the defense trade. These aren't companies that suddenly lose relevance because commercial aviation gets hot again.
I disagree. The market's pricing in a normalization of defense spending after 2 years of geopolitical premium. When commercial aerospace shows genuine margin expansion potential, investors rotate out of the defensive plays.
Sarah, we still have an active conflict in Europe, tensions with China over Taiwan, and now missile strikes in the Middle East, affecting commercial aviation directly. This isn't exactly a peacetime environment.
But that's my point. The geopolitical risks are becoming operational realities that hurt commercial aviation, not theoretical threats that boost defense spending. Airlines are dealing with actual flight diversions and fuel cost spikes right now.
Okay, but think about what drives defense contractor earnings: program timing, milestone payments, multi year development contracts. That doesn't change because airlines have a good quarter.
It changes when the budget cycle turns, which is exactly what we're seeing with the new administration signaling more infrastructure spending and less military expansion.
That's a fair point on the budget cycle, but I think you're underestimating how much these defense contractors have diversified into commercial aerospace over the last decade.
How much diversification? L3 Harris gets maybe 20% of revenue from commercial markets. Lockheed's almost entirely defense and space. Northrop has some commercial aerospace exposure, but it's not driving their earnings.
But RTX, Raytheon Technologies, they're 50-50 commercial and defense through the Pratt & Whitney and Collins Aerospace units. And RTX was only up 1.8% this week, underperforming the pure commercial plays.
Exactly. That proves my point. RTX should be the perfect hedge, commercial upside with defense downside protection. Instead, it's lagging both sectors because investors are making a clean cyclical call.
Or because RTX has company specific issues with the Pratt engine problems that we mentioned earlier.
Those engine issues are actually a medium-term positive for aftermarket revenue. Every Pratt engine that needs early maintenance generates higher margin service revenue.
Assuming the airlines pay for it instead of demanding warranty coverage for premature failures.
Fair point, but the broader sector positioning is still clear. Investors are rotating towards cyclical recovery stories and away from structural defensives.
Let's look at the eVTOL space, because that's where this cyclical versus structural debate gets really interesting. Joby up 23%, Archer up 12%. No.
That's pure momentum trading on the infrastructure spending theme. If the administration's serious about urban air mobility as part of the transportation package, these companies benefit structurally.
But they also benefit cyclically from higher conventional aviation costs. When jet fuel hits $4.50 per gallon, electric vertical takeoff suddenly looks economically competitive for short urban hops.
I think that's backward. eVTOL adoption depends on regulatory approval and infrastructure buildout, not relative fuel costs. These companies are still years away from meaningful revenue.
Joby just filed their 10Q showing continued progress towards certification. The quarter ended March 31st, so we're getting current operational data, not just investor relations spin.
Progress towards certification doesn't equal revenue. And with airlines suddenly profitable again, there's less urgency to develop alternative transportation modes.
Unless you're talking about urban markets, where airports are capacity constrained and ground transportation is gridlocked. Higher airline fares make short distance eVTOL more competitive, not less.
That assumes people treat eVTOL as a substitute for airlines rather than ground transportation. I think the competitive set is more Uber and taxi services than American Airlines.
Maybe for short urban hops, but what about connecting secondary cities to major hubs? That's traditionally been served by regional airlines flying 50-seat jets that are getting uneconomical.
Now, that's an interesting use case. Regional airlines like SkyWest were up 8% this week, but if fuel costs stay elevated, some of those thin routes become unsustainable.
Exactly. And that creates the market opening for electric aircraft on routes that can't support conventional airline economics anymore.
I'll give you that the economics might work on specific routes, but the infrastructure requirements are still massive. You need charging stations, landing pads, air traffic control integration.
Which brings us back to the infrastructure spending theme that's driving the eVTOL rally. These stocks are moving on policy expectations, not operational fundamentals.
Right, and that's why I'm calling it a structural play rather than cyclical. If the policy support materializes, these companies could build sustainable competitive advantages. If not, They're essentially research and development projects with public equity funding.
The risk is that they're getting valued like they've already won the policy lottery when we're still in the early stages of both regulatory approval and infrastructure development.
Agreed. But the same critique applies to the airline rally. They're getting valued like fuel cost pass-through and capacity consolidation benefits are permanent, when both could reverse if new competitors enter or fuel prices normalize.
That's the difference between cyclical and structural, though. Airlines benefit immediately from reduced competition and higher fuel pass-through. AVTOL companies need years of perfect execution on technology, regulation, and infrastructure.
But airlines also face structural headwinds: aging fleets, pilot shortages, airport capacity constraints, environmental regulations. The cyclical tailwinds could be masking underlying challenges.
All fair points, but airlines generate actual cash flow today. eVTOL companies are burning cash to develop products that might generate revenue in 2030 or later.
Which is exactly why the market's treating them as different investment categories. Airlines are cyclical value plays. eVTOL is speculative growth on structural transformation.
And defense contractors are caught in the middle. Steady cash flow businesses that are getting derated because they lack both cyclical upside and transformational growth potential.
That positioning could create opportunities, though. If defense budgets hold up better than expected, those stocks could outperform on both relative and absolute basis.
Especially the ones with more commercial aerospace exposure. Companies like Textron, which was basically flat this week, they've got both defense and commercial aviation through the Bell helicopter and Cessna aircraft units.
Textron might be the better hedge than RTX, actually. Less engine-specific risk, more diversified end markets, and still trading at reasonable valuations.
The week ahead is going to test whether this sector positioning holds up or reverses.
Let's dig into that timeline and see what could change the narrative. Looking ahead, we've got 3 potential catalysts that could either reinforce this week's sector positioning or completely reverse it.
The most immediate is fuel price direction. We're at $181 per barrel for jet fuel, which is obviously unsustainable for most airline business models long term.
But the question is whether it comes down due to geopolitical resolution or economic demand destruction. Those have very different implications for airline valuations.
If the Middle East situation stabilizes and rerouting costs normalize, airlines keep the pricing power they've gained from Spirit's exit while reducing their input costs. That's the Goldilocks scenario the market seems to be pricing in.
The alternative is that high fuel costs persist and we see more airline failures, which creates additional capacity reduction, but also raises questions about industry financial stability overall.
And then there's the third scenario where fuel costs drop, but new ultra-low-cost competitors emerge to fill the void left by Spirit, which would eliminate the pricing benefits entirely.
That third scenario seems unlikely in the near term, given how difficult it is to secure aircraft leases and financing right now. But medium-term high airline profitability always attracts new entrants.
The second major catalyst is the defense budget process. We're still early in the congressional appropriations cycle, and the market's assuming defense spending gets cut to fund infrastructure programs.
The politics of that trade-off are more complicated than the market's acknowledging. Defense spending has bipartisan support. Infrastructure spending requires sustained political commitment across multiple years.
Right. And defense contractors have multi-year contracts that provide earnings stability even if new programs start to slow down. The market might be overreacting to short-term budget rhetoric.
Plus, international tensions haven't exactly decreased. Even if domestic priorities shift toward infrastructure, international situations could force higher defense spending regardless of political preferences.
The third catalyst is regulatory approval timing for both eVTOL certification and Boeing production ramp-up. Those are the wildcards that could change competitive dynamics quickly.
Boeing getting approval for higher MAX production rates would flood the narrow-body market with aircraft, just as airlines are gaining pricing power from reduced capacity. That's potentially negative for airline margins.
unless demand growth accelerates enough to absorb the additional capacity, which brings us back to the fundamental question about post-COVID travel patterns.
This week's TSA data, 12.3 million passengers, up 3.6% year over year, suggests steady demand growth but not explosive growth.
3.6% year over year isn't enough to justify the airline rallies if Boeing floods the market with aircraft and new competitors emerge to replace Spirit.
Which means the airline rally depends on sustained capacity discipline, and that depends on either continued financial stress in the industry or regulatory constraints on aircraft delivery rates.
Neither of those feels like a sustainable foundation for long-term airline outperformance.
The eVTOL regulatory timeline is equally uncertain, but with different implications. If the FAA approves commercial operations ahead of schedule, companies like Joby and Archer could generate revenue earlier than expected.
But if certification takes longer than expected, or if early operations reveal safety issues, the entire sector could get re-rated downward quickly.
Right, and unlike airlines which have established revenue streams, eVTOL companies are entirely dependent on regulatory approval and market adoption for their entire business model.
From a portfolio positioning standpoint, this creates some interesting hedge opportunities. You could go long airlines and short eVTOL on the theory that near-term airline profitability is more reliable than long-term aviation transformation.
Or you could do the opposite, short airlines and long eVTOL, betting that high fuel costs and environmental pressure accelerate the transition to alternative aircraft technologies.
The defense trade is probably the cleanest, though. If geopolitical tensions remain elevated, defense contractors are undervalued relative to their earnings stability. If tensions decrease, commercial aerospace benefits from reduced fuel price volatility.
That assumes defense and commercial aerospace move inversely, which isn't always true. RTX and others benefit from both defense spending and commercial aviation recovery.
True, but the market's treating them as either-or propositions this week, which creates mispricings for the diversified players.
The key question for next week is whether these sector rotations continue or reverse when investors start focusing on actual earnings results rather than macro themes.
We've got several aerospace companies reporting in the next few weeks, which should provide real data on how these fuel costs and capacity changes are flowing through to financial results.
And that brings us to our synthesis of what this week really means for aviation investors.
Because it's not just about individual stock moves, it's about how structural changes in the industry are creating new winners and losers, how cyclical factors are interacting with long-term trends, and how regulatory decisions could accelerate or reverse these positioning trades.
The story connecting all these data points is capacity consolidation, accelerating under fuel cost pressure, while policy support creates opportunities for alternative aviation technologies, generating sectoral divergence that reflects both cyclical recovery trades and structural transformation bets.
That's a lot to unpack, but I think it captures the essential dynamic. Airlines getting immediate benefits from reduced competition, aerospace suppliers benefiting from extended order backlogs, and eVTOL companies getting speculative premium on policy expectations, while defense contractors get derated despite stable fundamentals.
Right. And the critical insight for investors is that these trends could all reverse quickly if fuel costs normalize, new competitors emerge, or policy priorities shift.
Which means the week ahead could either reinforce these positioning trades or trigger significant reversals depending on how the fundamental catalysts develop.
For Aviation Intelligence Weekly, I'm Sarah.
And I'm Mike. Thanks for listening, and remember that all information discussed today is for educational purposes only and should not be considered personalized investment advice. Past performance does not guarantee future results, and all investments carry risk of loss. Always consult with qualified financial professionals before making investment decisions.
Welcome to Aviation Intelligence Weekly with Sarah and Mike, your guide to the aviation industry. Want the inside track on aviation's biggest players? Aviation Intelligence Weekly brings you expert analysis of airline earnings, breaking industry news, and deep dive company histories. From American Airlines to Boeing, we cover the business of flight every week. Subscribe now on Apple Podcasts, Spotify, or wherever you listen.